Hey, good afternoon, everybody. This is Brian Greer with Tax Connects. Definitely appreciate everyone joining us today. Before we get too far down the path here, I'm just going to go through a couple of quick housekeeping items. Everybody who has joined us is on mute currently, so if you do have any questions throughout the presentation, hopefully you're familiar with the GoToWebinar panel. There is a questions dialog box, so please submit those questions throughout the presentation. We'll do our best to either address those during the presentation, or we'll have a little bit of time towards the end where we can get to a couple as well. So we're scheduled today for about 30 minutes, so hopefully we can get through everything in that time, get you guys back to what you need to do with your day jobs. But with that, I will introduce myself as well as my colleague in crime today, David Rubenstein. I'm one of the partners here at Tax Connect. If you're not familiar with my firm, we do specialize in the sales and telecommunications tax arena, primarily focused in the compliance area in terms of the preparation and filing of the various sales and telecom tax returns. But the star of the show here today is David. You see he's a senior telecommunications tax specialist with our partner, Walters Kluwer. He's a licensed CPA and has been in practice, been a CPA for a long time, David. I didn't realize it was 1983, so you're coming up on 40 years as a CPA. So congrats to you on that. We've worked together on quite a few client projects over the last 10 or 15 years, and it's always a joy to work with David. I'd consider him one of the foremost telecom experts in the country, so we're fortunate to have him here today. So super excited, David, to have you. Welcome. From a agenda perspective, let me just kind of run through this real quickly, and then I'll turn it over to David. But the topic today and the focus is really on telecom tax optimization. So what does that mean? We're going to try to break that down for you and look at it in a few component pieces. And I would suspect that most, if not everyone here today, is probably a telecom service provider of some variety. That being the case, you're probably familiar with this dreaded federal USF and the highest, in my opinion, risk point, certainly the highest contribution or tax rate factor that we have to deal with from a telecom perspective. We're going to talk about that federal USF and how we can potentially minimize that cost to our clients. David's going to talk about bundles of services and specifically how to unbundle certain services, because what tends to happen when we bundle items together, it tends to taint the entire bundle and the entire bundle becomes taxable. We can potentially unbundle some of those items and again, reach a lower overall tax obligation for our clients. We'll talk about mapping a little bit as well. Mapping being the connection or the link between your SKUs or your product codes linked directly into a sales and telecom tax calculation solution like SureTax, which is a Walters Kluwer product that David and his team work on quite a bit. And then kind of wrap this up with the overall kind of cost recovery factor in terms of, is there a way to maybe even turn this tax and regulatory compliance obligation into a profit center rather than a cost center within your business? So with that as the background, David, I'll turn it over to you, and welcome.
Thank you so much, Brian. Really glad everyone to join us today. First, we're going to talk about the real hurdle over here in telecom billing space and compliance, which is the FUSF. The FUSF is reached historic heights in terms of it. I guess it's a misnomer. What FCC calls it to be a contribution. A contribution, you would think if someone knocks on your door and maybe if there was a no solicitation sign, it wouldn't happen. But if they knock on your door and for alms, but this is not at all a charitable contribution. This is a heavy tax. It's the heaviest telecommunications, the heaviest taxed product and service in the United States. Who has to contribute to this? Well, if you're what's called de minimis and you're a startup, you're not yet liable to contribute. If your annual liability would be less than 10,000, that would translate into about $39,000 of combined interstate and international revenues. Now, those revenues are the tax base of the FUSF. The current rate, as you can see, is 32.6%. Prior quarter was about almost 29. It had been really been around this very high rate going back last couple of years, and it's really created, like I said, a monkey wrench in terms of being able to deal with invoicing being at such a high rate. I know there's no sign of this going down. As you can see, it's just really just going higher and hitting and sustaining that very high rate. So there's really no anticipated let up over here. Well, what can we do to deal with this? When you're billing a service for $100 of service at a 32.6% rate, that's just FUSF standalone. It's not including the sales tax, gross receipts tax, excise tax, 911. You're looking at a really huge burden on your consumer and then ultimately yourself, if you have responsibility for filing these taxes. Now, there is something called a safe harbor, which FCC gives you as a default of sorts to help bring the rate down. That safe harbor rate for voice over IP is 64.9%. As you can see, for $100,000 of revenue, that would translate into a 21% or so effective rate. Now, there is an alternative method, which would be to do an actual, we call PAU, or percent of interstate usage. And what we will do there is go with a traffic study. You would do a traffic study, and we highly recommend that every VoIP carrier do this. Do a traffic study, which should significantly bring down the rate, and that should take it down from the 64.9, which is FCC somehow years ago calculated that was the average interstate/international, and we haven't seen that borne out at all. There has been a mention, we saw somewhere that someone said the real rate is really more like 22%. We've definitely seen it in the 20s, are very common. So wherever it lands is based on actual calculations. There is a bit of a formula to follow. Your compliance provider should be able to assist you with that. It is an internal effort, but it's submitted to the FCC, to the administrator of the FCC's FUSF, which is USAC, and you submit that to USAC to bring down that rate. Hopefully, when all the dust settles, you'll be somewhere, if all goes well, about a third of your liability just from just doing a traffic study alone.
Yeah, David, one of the points you mentioned before in terms of this de minimis factor and this $10,000 of annual contributions to the Federal Universal Service Fund, I like to guide people a little bit in terms of, what does that mean from a telecom revenue perspective? And people can certainly do the math on that, but if you are applying the safe harbor, also applying the current contribution factor, the number I'm going to share with you, it changes, of course, from quarter to quarter based on that contribution factor. But I encourage providers that once they start having, $50,000 a year, basically, of telecom revenue, that's the moment that you kind of start to flip in terms of, now being responsible for contributing directly to the USF fund rather than being, just a non-contributor. Being a non-contributor and being under this de minimis amount basically means that you're not paying directly into the fund yourself, but your upstream carriers would be charging the applicable USF fees to you. You would pay your carrier, file a zero due report to USAC. That would be for a de minimis non-contributor. And then once you get over that de minimis factor, you would then contribute directly into that USF fund and hopefully seek an exemption with your upstream carrier. So kind of keep that in mind as you're, if you're new to this and kind of growing your business, at some point that flips and your responsibilities change a little bit.
That's a good point, Brian. Now, just bear in mind that not always going to go to the actual PIU. We actually had one customer who insisted on going to do the actual PIU and do what's a traffic study implementation. Even though their interstate traffic was unusually, and that was being higher than the 64.9, went ahead, implemented, they insisted on it, and then years later, the internal tax regime changed. The new people looked and said, why are we doing this? And I said, because your previous tax director was insisting on it. And they said, oh, we don't want to do that. So they went back to safe harbor. Well, if your interstate's higher, you definitely want to go with safe harbor. It's an option. It's kind of like itemizing your deductions or not. You go with whichever one's better. But typically, it's much better to do traffic study and bring it down to the actual PIU. So what's another, besides traffic study, which is should be a big win, another big win in terms of cutting down your overall tax burden to your customer and yourselves as a telco, or as bundles, or we say unbundling. When you typically a VoIP is offered today, as a package or a suite of services. You're going to have in that package on a high level, you'll have typically your voice line, sort of channel. You're going to have accessible and non-accessible features. Then you also have, besides these telco features, you'll have non-telco features, more like computers, which fall more likely under computer service or of various types. So all these component parts are within your bundle. Now, if you don't unbundle, you're just going to be mapping to a system that one-to-one relationship to a tax code of a line charge. A line charge is going to tax you to the max. If you wouldn't do anything with safe harbor, you'd have the 21% or so FUSF. You'll have another, well, in New York, another 8% and change, for example, just of sales tax, another to a couple of percentage points for excise tax, and 911 another $1 or so per line. You add it all up, and you're probably in somewhere in the low 30 percentile for your VoIP service. That would be if you don't unbundle. So, but unbundling can create also sensational reduction. So let's take a look at that sample bundle. A sample VoIP bundle, $25, $24.95. We're going to use a fixed VoIP line. Now, fixed versus nomadic does make a difference. That's something, a determination which you need to make. Fixed is typically fixed to a location. You use that service remotely. Let's say if you have a cable provider. So in this case, we use that as for the example. Now they're going to be $5. You just like to throw out there. Now these amounts are not clad in stone. This is just a sample. But unlike the other items on this list, that $5 should really remain constant. Perhaps the standard features would also, because the reasoning being anything accessible under the FUSF needs to be constant. The others would probably wind up being a percent of the bundle, because you may change the pricing, right? So you might discount that bundle, and then you need to adjust your bundle charges based on the discount. So it's good to have at least a majority of your bundle set up in percents. Well, let's walk this through a little bit. So tech support may or may not be part of your package, or may not be something you're going to allocate to. But in this case, we did. Some clients offer a kind of a premium tech support, and it'll allocate part of the bundle for that. Your standard features would be your call forwarding, call waiting. It doesn't really play in too much into today's contemporary VoIP scene, because most of the features are really what we call enhanced services. Enhanced services is a FCC term. It's really related to the FCC's definition of telecommunications service versus information service as far as what's accessible as opposed to what's not accessible. The enhanced services would fall under the information service category. It'll be not accessible, and we'll walk through a little shortly what some of those examples are, but these are more, we say, computer-y type of services, even though they're ancillary to the telephony. Ancillary meaning they're subservient or what assist the telco service, but being that they're more computer in nature, I don't know if that's a word in Webster's dictionary, but we like to use it anyways, that'll get it out of the realm of the FCC assessment. Voicemail typically is part of a VoIP package, whether it's $2 or $1 or whatever allocation, that's your determination. Apps is becoming more and more a role. And by apps, we mean software as a service. Software as a service becoming a big part of the VoIP bundles. We're also seeing PaaS, which is platform as a service. And, between SaaS and PaaS, you would think you'd have at least as much play as we're showing here, if not more. It really depends on what the product, how your feature set. The advantage of going as much as allocating as much as you can to SaaS and or PaaS is because they are only taxable for under sales tax, and not in all states. So maybe about half the states or a little bit more, a tad more, but that's it. There's no FUSF, there's no excise tax, etc. So you have a huge tax win when you can allocate to your bundle. This is by the way, a great asset on a tax audit if you're able to work through these with things like apps. SMS is also typically part of a VoIP offering, whether it's this dollar amount's probably a little high, but the advantage of going here, allocating here is again, no FUSF, because interestingly, the FUSF, the FCC, sorry, has been petitioned but never responded to the request to comment on this, and therefore, the silence is kind of creates a roar of that's non-accessible. They've certainly given the opportunity to weigh in on this, and they have not. DID is a bit of an anomaly, exactly, kind of something that comes up a lot in telecom, unfortunately, which is it's like trying to nail Jello to the wall in terms of understanding its exact taxability role. Certainly, the first question is FUSF. Is it considered two-way interconnected VoIP or not? It's a direct inward dial. You would think it's intuitively one way. On the other hand, it's ancillary to two-way interconnected VoIP. We could spend a lot of time arguing both sides of it, but we won't, given the time constraints here. In this case, we mapped it to a code in the SureTax system, which is intrastate, which is not subject to FUSF.
Hey, David, quick question on this unbundling aspect here. Is this something that the service provider, when they bill the customer on the invoice, are they breaking out these individual line items on the invoice, or do you still see kind of a single $24.95 line item charge, and then you're managing the bundle or the unbundling behind the scenes in the billing system?
Sure. So I can't speak to every billing system. I can tell you the way it works in CC at SureTax. We have a revenue allocation manager, the bundle set up there. It breaks out the bundle in the calculation, and then but on the invoice it gets pulled back together and it just shows as a single line. I think that's really best practices. You want the customer, you don't want them to see the whole, what goes on in the kitchen. They're buying this package. That's what goes on the invoice. As far as the tax calculation, that's something behind the scenes.
Gotcha, makes sense.
So how do you do the unbundle? Well, we showed you the after a sample after effect, but how do you get there? Well, let's try to see if we can come up with some best practices. So think about a package. What does it mean we package something? We package something, we're going to discount it, because by nature, right, if you're going to go to an oil change and they offer like a whole bunch of things that they'll do in your oil change, if you say pay them individually for it, you're going to pay more. It's like any other service package. So the individual parts, if you add them up, will be more expensive a la carte than the total sum, which is going to happen when you go price each of these each of your components in your bundle. So what you're going to wind up doing is needing to discount them. Now, problem is, we mentioned before, FCC is not happy about your discounting accessible services, something you don't want to discuss with your regulatory attorney. The other hitch is here, that if you don't have that, if you don't have a market price, which you're very likely not to have in most of the bundle, what do you do? So first thing you want to do is, if let's say you have 25 items in your bundle, or something we've seen even much more. First, you want to like tag them. You have your buckets, which we kind of laid out in the previous screen, the samples. Have your buckets, and then assign each of the component parts to a bucket. And then you're at least you worked it down from 25 to, let's say, half a dozen, 6 or 7. Now that you're down to buckets, it'll be a little easier. Some of those component parts, hopefully you do have MSRP, let's say the line charge, and hopefully a few others. The ones you don't have, those are kind of challenging. One thing we've seen customers of ours do is to calculate what the costs are, and then use kind of cost allocation uh, relative to the entire package for the component bucket parts, to allocate costs. Ultimately, you really want to have your legal team weigh in here to make sure at the end what you wind up at the end of the day, it flies and makes sense from a legal perspective. Not easy, but we found, I think our customers have found, and I think you'll find as well, that it's well worth the pain. So there is one little thing that you need to do, not such a little thing, but important thing to do before we go to the next step, after we've already done our traffic study and come up with our revised numbers, after we've unbundled our bundles. We want to make sure we kick the tires on our mappings, because what happens is product mappings get stale. So, basically the minute after they've done, they got stale. You're constantly offering new products, changing component parts of bundles, and changing pricing, which will affect the allocations. And how often, this really just depends on your company, but it does happen quite frequently. We recommend minimally to review your product mappings annually. It could also be precipitated to need a mapping based on acquisition. The newly acquired company most likely doesn't have a similar tax policy to yours, and you want to make sure that you bring them into line. Obviously, there's considerations there in terms of historical, customer-facing issues and stuff like that. But at the end of the day, you're not going to be bringing this company into filing under your tax ID. So you want to make sure that you're consistent in the mappings of their products. If they were using a different system, it can make it a little more complicated. You'll need to do a conversion, but that is crucial that those mappings are brought into line. Now, just a little disclaimer, mappings are not necessarily all bulletproof, like one size fits all. They can vary depending on how the product's deployed. It really say, I hate to use legal, the cliche, but it really depends on the exact nature of the product, its deployment, and it really needs to be looked at on an individual basis. And there may, at the end of the day, be a few different ways you can map a product. Very often things are on the fence in telco. The more granular the content is that you're mapping to for the tax engine you're using, obviously the easier it'll be to map. It gives you more options. It can be a little overwhelming, so make sure you have a seasoned tax professional. But your tax optimization process begins where good, solid product mappings leave off. Last but not least is cost recoveries. We could probably spend a few days on the topic of cost recoveries. We're just going to introduce the topic here, and please feel free to reach out after this presentation to either of us about this. But what the goal here is on a strategic level twofold. One is that you can really increase your bottom line dramatically by cost recoveries. If you look on, if you'll see invoicing from a lot of companies, you see items on invoice that are, when you start to peel away the onion, they're obviously they're obviously not taxes. Taxes are, in the sense of they're not remitted to the government. These go straight to your pocket, straight to the bottom line. What you can do, and we've seen a lot of customers do this effectively, bring down your tax rate, whether it's traffic study, bundles, whatnot. At the same time, bring up your cost recovery. And that once you do that, it kind of minimizes the damage control in terms of what your customer reaction is to seeing a larger cost recovery, because at the end of the day, that might not necessarily change the bottom line on the invoice. Yeah, a lot to talk about in cost recoveries, but we're just going to touch on it here. Just understand that when it comes to tax optimization, the ultimate goal here is to bring this to your bottom line. And by being smart about how you manage your taxes, hopefully you can introduce, if you haven't already, or bring up the amount of cost recoveries. Obviously, there's parameters around that, and really drive home a nice profit margin for you and your business. Thank you very much.
Hey, thank you, David. I think we've got a quick poll question here, really just oriented towards whether you'd like for one of us or someone to follow up with you with a specific question or concern or comment regarding what David's described to you today. We'll leave that open for just a minute, and then I've got a question or two here that I'll throw out primarily here to you, David. But the first question, I was curious about the traffic study, and I certainly see the value in terms of being able to minimize the USF contribution from a carrier perspective or from a service provider perspective. There's obviously a cost associated with conducting a traffic study. Do you see a certain type of telecom business and maybe a revenue size where you see more frequently that they will conduct the traffic study versus, a brand new entrant? It may not necessarily be worth the cost, but maybe someone that's certainly larger. Do you see any kind of a breaking point where it makes sense to do it, or would you encourage everyone to do it?
I think you need history to do it, right? Because it's going to take your prior year historical traffic. So once you have your history, yeah, it doesn't really matter what size you are. It's definitely worthwhile. Just a matter of, you need at least a year of traffic to be able to analyze it and to submit your traffic study. But that's something which you should really work with your compliance provider on, to guide you, your regulatory attorney to guide you around the process. We find that we found unanimously everyone thought it was worthwhile. We haven't had anyone saying, "Oh, I really wish I hadn't done a traffic study. It was just too costly," or whatever. I have yet to hear that feedback.
Sure, makes sense. Another question here for you, David, and it kind of relates to the last question, or the last topic in terms of the cost recoveries. Are there any limits to how much a service provider can charge from a cost recovery perspective?
Right. So it is what it says. It says cost recovery. So you're recovering actual costs. So based upon your cost analysis, then you're going ahead and recovering it. Now, we haven't seen or heard that there's been something that the FCC has ever gone in and audited its cost recovery, which kind of interesting. But the concept is it's supposed to be based on actual costs. So it's a numerator denominator calculation to come up with the percent of what the cost is, cost of recovering. Typically, you're talking about cost of compliance when you're dealing with a telco. So, and how broad that is, and etc. That's something you'd probably want to probably run by legal. But again, it is by definition a quote unquote cost recovery. You're covering meant to recover actual costs.
Gotcha. Hey, last question here, and I'll field this one, and it'll be a little bit of interpretation. It's from Daisy, and she asked regarding specific state thresholds. Do state thresholds apply to telecom business? And I'm interpreting that and guessing that we're referring to some of these economic nexus thresholds in terms of the $100,000 versus 200 individual transactions or invoices, creating nexus responsibility. We don't see those, and I'm speaking to this from a Tax Connects advisory perspective. We don't see those as applicable in the telecom space. What we advise clients, the short answer is where you have users, you have nexus and the requirement to collect the applicable taxes. The rationale being the states look at the telecommunications service and consider the infrastructure that's required to deliver that service. The infrastructure being fiber, switches, poles, whatever that hardware, whatever that infrastructure is within the state that allows you to bring your service into that customer, albeit you do not own that infrastructure. The states will say that you're utilizing and taking advantage of that infrastructure, and therefore it's creating nexus for you as a telecom provider, and therefore you're obligated to collect the applicable taxes. So that's our perspective on that. I think we're at the end of the presentation here. You've got some contact information if you want to follow up. Shauna works with David on his team, so feel free to reach out to Shauna at Wolters Kluwer or myself here at Tax Connects if you have any additional questions that we didn't get to. Thank you all for your attendance. We appreciate it, and look forward to seeing you on the next webinar we do. Thank you, David.
Thank you. Bye-bye.